So chapter 10 is going to be more of a macro view, kind of the big picture of what's going on and some of the federal regulations that come into play. And when we get to chapter 11, it's going to be more of that micro view. We're going to be looking at what specific instruments are you going to be using to finance this or to finance some type of seller financing, that type of thing, and the specific clauses within the mortgage and notes. And so the first part in particular, we're going to add to all that alphabet soup that you guys have been learning for the last couple of weeks. There's a lot of acronyms, some things that you may have heard before. I'm sure there's a few things in there that this is your first experience with. And so this is going to be one of the three hard parts on the exam. If you look at the historical trends for the A&P exam on a national basis, there's three areas where students tend to not pass. Fortunately, they pass the other areas well enough that it carries them through these sections. And so any points you could get in this area is great, but these are tough areas. And so you have finance that we're going to talk about today, settlement, and then just math in general. And part of your math is going to come out of what we're going to discuss. The slides, by the way, are fairly generic. It'll just say the name of the statute, and it typically doesn't give you too much on that. And so we'll be filling in some of those blanks. Has anybody refinanced their house last year or two? Yeah, you should. The interest rates are phenomenal right now. And so where'd you go for your financing? Bank of America? Okay. So we have Bank of America, we have some of the other big banks, Wells Fargo, Citibank. We have some of the smaller banks, regional banks around here, MetaBank, Great Western, First Bank and Trust. All of those types of banks, those are kind of the retail part of that mortgage market, right? That's where we're going to go in to shop around, look to see what we can get. And so one of the terms that they used in what you read was primary mortgage market. And so this is just a way for us to think another name that we can put on the banks. But primarily what we're thinking of is, where's your checking account? Where's your savings account? Who are you going to go talk to if you need a car loan? Who are you going to go talk to if you need a house loan? That place fits into that primary mortgage market. Now, let's say that we had $1 million sitting around. You wish? And we decide that we're going to use that $1 million to get into the mortgage business. So how many loans can we make with that, Cameron? Yeah. Does anybody know the average price of the house in Sioux Falls? Yeah, about $140,000 right now. Before the recession started, the median price was right in that 170 range. And so it's not that values have declined here, but our purchasing decisions have changed. And so the average house that people are buying are less now after the recession than what they were prior to the recession. So right now, the median price house in Sioux Falls is about $140,000. We could say $150,000. So if we had two of those, that would be $300,000. If we multiply that times 3, that gets us to $900,000. So we have 6 houses, and we might be able to wiggle in a $100,000 mortgage, and then we're out of money, right? We have to wait until all those get paid back. And what are typical mortgages? How long? 30 years. And so it's a long time before we can make another loan, isn't it? Okay, so that's not going to work very well for us. So we're going to need some other source of money. And that's where the secondary market comes in. And so when we are looking at the secondary market later on today, we're going to have all of these names. Fannie. Everybody likes that name. Freddie. I'm kind of partial to that one. Yeah. And so those are the traditional secondary market players. We also have these things that are called like Merrill Lynch. You have, what are some of the other ones? Is Bear Stearns still around? Yeah. And so you also have these investment companies that want to have basically a safe place to put some money. And so they're also involved in the secondary market. And so what happens here is that the secondary market is going to give money to the primary market, and the primary market bundles those mortgages and they sell them up to that secondary market. And so now when our $1 million runs out, we just call up Fannie and say, hey Fannie, we need some more money. How about you buy these mortgages off us? And they send us another $1 million. We give them the mortgages we have, and we're in business again. Now that has its limits also, because theoretically that secondary market's going to run out of money at some place, some point. And so we have the other side to this. Is the investors. And again, these investors are going to be a wide array of different entities. You're going to have your Merrill Lynch's, you're going to have your Bear Stearns, your big investment houses, you're going to have labor unions investing pensions into some of this, you're going to have trust accounts investing into this. You have a lot of different investors that are going to give the secondary market money. And in return for that money, the secondary market is going to give the investors this thing that's called a mortgage-backed security. And so a mortgage-backed security is kind of like a bond. They come up for bid, and you say, I want a 4% return on my money, and Fannie Mae says sold. And so you give them $100,000, and they're guaranteeing you a 4% return on that. And so that keeps Fannie Mae full of cash, so they can continue to give that primary market cash. Yeah, that's a really good question. And so the question was, correct me if I'm stating this wrong, Jeff, but don't they have to pay more for the mortgage than what they're getting? Okay? Because it's kind of that whole profit thing, right? What is happening is a thing that is referred to as discounting. So what the secondary market is buying is a stream of income. So they're buying a $750 a month mortgage payment for 30 years. Okay? So that's roughly a $167,000 loan for this payment. So now we take 750 times 360 payments. And so this $167,000 loan is actually going to be $270,000 total in payments over that 30 years. Okay, so that includes that interest that's on there. And so what the bank, what Fannie Mae does, anybody on the secondary market, they have this total cash flow over 30 years. What's that worth today? And so the bank, the primary mortgage market, is going to make a lot of their profit on origination fees. And the other thing, and this is kind of letting you in on the secrets of the industry, is if this primary, let's say that the current interest rate is 3.5%, and I'm a loan officer sitting in one of the banks we talked about, and I'm good at my job, and you come in and I give you a really good spiel, and I get you to sign a note for 3.6%, guess what? I get a bonus because I just had you enter into a note that is above market level interest rates. And so now when we turn around and sell this to Fannie Mae, because this is a higher interest rate, they're going to pay us a little bit of a premium on the backside. And so I make my money by the origination fee and potentially by that premium. And so when Fannie Mae comes in and buys this mortgage, they're buying this much closer to that $167,000 than they are at the $270,000 that they're going to receive over time. Okay? So that's where their profit is. So they use this profit then to pay the interest on the mortgage-backed security. Uh-huh. Because you have no clue what the market interest rate is.
So are they doing that this secret, or they want to know, or they don't have to disclose that when they ask for
There's no market interest rate is called PAR, and so if you want to kind of even the playing field when you go in to shop for a mortgage, just ask the loan officer, what is PAR today? And they'll probably stammer a little bit because they don't get that question a whole lot. Usually they can pick whatever rate they want, but that's where everything's even. They get no premium, and you don't have to pay any discount points. And we'll look at discount points in a little bit. Yeah, but it's not, the internet's not as up to date as what the lenders are. And so when I was running our mortgage company, we would get interest rate sheets 2 to 3 times a day. And they're only good for those 3-4 hours. And so Wells Fargo said this is the rate that they're paying right now. And by the afternoon, that could change. And so that's why those of you that have gone through the real estate financing stuff at a bank, you always have that option to lock the rate because that rate varies quite a bit. And so if you walk in and you get PAR today, you lock it in. That's great. Now, if interest rates, when you close, happen to have gone lower, you're out of luck, and the bank's going to be getting a premium on that again because they have that above market rate. Now, where we fit into this whole thing consumers. So we're going to be the one, switches around a little bit here. We give the bank the mortgage, And the bank gives us the money, right? Now, through our 401ks and other investments and things like that, we're really giving that money back up to the investors too, so this whole cycle can continue. Now, this works great as long as every portion of that cycle is healthy and there are good decisions being made all the way around that. You know, when we saw a lot of greed that started here, here, and here in the late 90s and 2000s, and that greed created a thing that just wasn't sustainable. And when that all fell through, you know, most of the burden actually fell back on to the consumer, ultimately, in that case. And so it affected our ability to get loans, it affected our ability to buy houses, affected the values of our houses, our retirements, all of that kind of stuff suffered from that. And so what this first chapter is talking about, it's kind of taken us 20 minutes to get to this point, is just looking at the different aspects within this finance circle, where every piece and part fits in. Is there any questions over that? So who would have thought when you signed up for real estate class you would become this expert on the financial system, huh? Or on appraisal, or on fair housing. All right, so to start off chapter 10, you notice that there's a ton of keywords there. I'm sure Colby has told you, but these keywords are very important. I would say about 70%, 60 to 70% of the national exam is going to be primarily vocabulary based. And so you understand these terms, you're going to have a very good shot of passing that national test. Anybody that's struggling with it, I would strongly suggest you start making yourself some flashcards. They help out quite a bit. You're going to have a lot of them, but they do help out. So we start off talking in chapter 10. The very first thing in there is Federal Reserve. And the Federal Reserve is made up of 12 districts around the country. And this group is in charge of the monetary policies within the U.S. financial system. And so they're going to have the monetary policies basically that govern any type of bank, spendthrift that fits under their regulation. And so there are three things that they really control. One is the discount rate. But right now, the discount rate, this is the rate which banks can borrow from banks, and it has a direct impact on our short-term consumer loans. So if we were to go buy a car, that type of thing. But right now, the discount rate varies from plus or minus 0.25%. And so it's basically zero during this whole recession time. They also can set reserve requirements for banks, how much cash they have to have on hand. And then they also control some of the open market operations. And so this is just kind of a fancy way of saying that they can put cash in and pull cash out of the system. And so they are the ones that kind of regulate if they're going to buy up some mortgage securities or not, if they're going to be some short-term T-bill sales, that type of thing. So that's how they control the money coming in and out of the system. The next section that they talk about under the Federal Reserve, even though it doesn't necessarily sit there, but this is the section that they really govern, the Federal Reserve does, is that primary mortgage market. We're going to look at this a little bit later on at the different people that are part of that, mortgage bankers, mortgage correspondents, mortgage brokers, and so forth. But they're going to be the ones that they regulate. So now we have about 2 pages of gibberish there. There are a couple of things that I want you to highlight that you have a great probability of seeing on the exam. The first one is FHA. What's that stand for? Federal Housing Administration. There's a test question right there. But don't count on it quite being so easy when you have a little test stress and they have Federal Housing Authority, Federal Housing Administration, Fair Housing Act. Which one is that actually? So FHA came about after the Great Depression. They have a little story there talking about It's a Wonderful Life. Has anybody ever seen that? You haven't? Oh man, it's black and white. It's the one downside to it, but it's a great story. It's got Jimmy Stewart in there, but he is president of I think they call it building and loan, something like that there, rather than savings and loan. But it's kind of the way that banks used to set up, that we would have one bank in town, all of us would have savings accounts, and they would use the money out of the savings account to lend money to folks that needed to buy a house. But they would lend it to you for 3 to 5 years. So that's how long you had to pay off your house. I remember my grandpa lecturing my dad because he thought it was silly that my dad would get a 15-year mortgage. And so he was very old school. And so now we have 40 and 50-year mortgages because if you live in California, that's how much time you need to pay back some of those loans on houses. But that system fell apart. It just didn't hold up. And so the very first person to come in and create this secondary market concept was the FHA. And that's what it was originally created for, was to provide a source of money for those small town savings and loans so that they could continue to help people buy houses. Now in the next section, the savings and loans today, very last paragraph, the very last line on that page is a term called disintermediation. That's another one you should highlight. This will show up, I would say, on a test in the future, and it's a good term to understand. And this is kind of an economic term where the concept is that people are going to invest money where they have the highest return. Does anybody know what you get on a savings account right now? Like 0.5% a year. And so where are you going to put that money? In a savings account? No. I mean, your mattress is probably safer than that. And so you're going to put it someplace else where you get that higher return. And so in the 70s, the stock market became available to the average Joe investor. And so you started to see the money not go into savings accounts, but into the stock market, into these other investments. And when that happened, it really stripped these savings and loans of capital. And so they become undercapitalized, just like we saw recently with banks. They weren't ever able to meet their obligations because they didn't have cash on hand. And so that term disintermediation applies to the reasons behind the savings and loan crashes in the 70s and 80s. Now, the next thing you need to know is at the bottom of page 169, and that is dealing with PHIRA, Financial Institution Recovery, Reform, and Enforcement Act. It's kind of a mouthful. A couple of things that you need to know about PHIRA. It was created kind of like our PHIRA Act today. It was created back in the 80s to save the savings and loans. So this was a financial bailout and regulation law. It created the SAFE Fund. And so this is an insurance fund that is there to bail out banks. This is where FDIC comes into play. And so when banks go under, FDIC steps in and they guarantee our accounts for how much? $250, okay? So $250,000 per depositor. And that money comes out of that SAFE Fund. The other thing that they did that you may see on the test that isn't necessarily on that list there is that they created the independent fee appraiser. And so prior to this, banks could do their own appraisals on the property. The real estate agent that sold the property could do the appraisal on it. And so you had all of these involved parties being part of the valuation process of the loan. And so there was no incentive to be impartial. Everybody was biased. And so they removed that and said, no, you need to have that impartial person look at these values before you do the loan. Okay, so now over on page 170, 171, we start to get into all these different entities that are part of our real estate finance system. And so the first one in here is insurance companies. Insurance companies love real estate, especially life insurance companies, because when we buy, in particular, a whole life policy, the insurance company has to figure out a way to make money because we're paying them X per month and they're guaranteeing us money when we die. And so how are they going to cover that? So they need long-term investments that actually have a good return. And so some of those safe investments historically have been real estate. One thing the insurance companies really like are malls. And so many of the major malls around the country at some point in time have probably been owned by insurance companies. But they also participate in the mortgage side of things. They're going to buy mortgage-backed securities. They're actually going to make some loans in some situations. And so if you see that clause that's italicized in there called participation financing, it is basically what it sounds like. I will lend you the money, but I want a 10% interest in your mall. I will lend you the money on the apartment building, but I want a 20% interest in that. And so not only do they get the interest on the loan, they get the rent proceeds from that equity position. And then if the property increases in value, that equity position also increases. And so it's just kind of a way for them to compound their returns. So that participation financing is probably more important than the insurance companies if you have limited brain space and you're trying to prioritize. And so keep that in mind. Commercial banks are another one that's going to be found in real estate finance. Now, commercial banks are a completely different animal than your residential financing. And so if anybody would go to finance something that a fiveplex or greater, if they would finance an industrial property or a retail property, when you go to the bank, they might amortize your loan over 20 years, sometimes 30 years in case of apartments. But that loan is only going to be for a maximum of 5. And then they're going to want to redo the loan at the end of that time period. And that's because this is their money. If they're in the residential world, remember, they're going to sell this on to Fannie Mae, And they could care less what happens 7, 8 years down the road. But if it's their money, they can look into the future for 5 years. And they're okay if interest rates go up to lose money for a little while. But at the end of that 5 years, they're going to want to have their note making whatever the market interest rate is. And so they're going to be short term. Now, many of the banks, I would say, with the exception of your big national banks, but many of our regional banks, like your Dakota Bank, Great Western, First Bank and Trust, Metabanks, those type of things, they fit more into this commercial bank world. They'll do the residential loans, but not very many of them keep the residential loans. You know, Home Federal is one of the few exceptions where they'll actually keep and service the loans for that 30-year time. Most of the other banks, if you go to any of those that I mentioned, chances are Wells Fargo is going to end up with that loan, or Bank of America. You know, some bigger bank, they're going to sell that off as soon as they're done writing it. And so if it's a commercial loan, though, it's going to stay in-house and it'll stay with them. Does everybody understand that concept? Trust funds. South Dakota has some very favorable trust laws. And so you go down to the 300 building downtown. This is this 5-story building that they have these 100 square foot offices, very tiny places. And it's amazing how many trust companies are tenants in that building, because we have very favorable laws. So they'll set up this kind of dummy office in order to headquarter out of South Dakota. And because of that, we see a lot of, probably more trust activity around this area than what a town our size typically would. And so these trust funds also are looking for these long-time returns. And so they're looking for those safe returns. And real estate is a great place to put that. The mortgage side of it fits right in there with the rest of the real estate investments. Does anybody bank at a credit union? A few of us. Credit unions used to be a horrible place to go and get a real estate loan. It's because they didn't do them. And so you just couldn't get one there. And they have started to act more like a mortgage correspondent in recent years, where they will make the loan and turn around and sell it on the secondary market. And so credit unions now are a viable place that a person could go and get financing. Pension funds are the next ones there. We've talked about that. Pretty much the same thing. They need to invest their funds someplace. One that has a little more likelihood of showing up on the test is a real estate investment trust over on top of page 72, or a REIT. Now there's two types of REITs. There are finance REITs, and then there are equity REITs. So an equity REIT is going to own the real estate investment, where your mortgage or finance REIT is going to be involved in that side of things. Now there's no rule except they have to invest in real estate for a REIT. And so you'll find some that kind of blend these investments. They'll do a little bit of both. But typically, REITs are either one or the other. And it's the ones that are in the finance, the mortgage side of things, that obviously are going to fit into this chapter a little bit more. But REITs, you'll find, are securities. They're like a mutual fund for real estate. And there's certain rules that they have to play by. Only 10% of the profits can be retained by the managing principals, and 90% of it has to be passed on. And so that's not necessarily true for some of the other mutual fund, money market type things that are out there. Any questions on REITs? Yep. Can, as an investor, or can you create one?
No, like an investor.
Yeah, you can create one.
You can't create.
Yep. And so it fits under securities law. So depending on where your investors are coming from and how big that REIT's going to be, you might have to register it on the SEC. But you would, if it's a registered one on the SEC, you just go on to the ticker and find it. And you know, a finance REIT that's out there is Anworth Mortgage. Plum Creek Timber is a bigger one that's on the equity side. And so you can look them up on the ticker just like you can any other stock. So state housing bond market. Anybody want to guess what they're talking about here? Okay. There we go. So first-time homebuyer program. So typically, this is going to have to be paired with another loan. So you have your first-time homebuyer, which is a little bit of a misnomer, plus a 203B loan. So that's one of the FHA loans that we're going to talk about in a little bit. Or you would have first-time homebuyer plus a VA loan maybe. And so first-time homebuyer programs are going to finance 3 to 5% of the purchase. If we look at your 203B, for those of you that might have done some reading, how much will a 203B finance? $97.5%. Okay, so you put that together and you're somewhere between 105 to what, 102.5%. And what I'm talking about in percentage is loan to value. How much is the loan in comparison to the value of that real estate? And so this allows that first-time homebuyer to get into a property with no money down. Okay, so it's a pretty neat program. They call it first-time homebuyer, but you can actually use this program a couple of times. The one requirement, and this is one of the things that you'll probably want to know for the test, is that you cannot have owned a home in the past 3 years. Okay, so those 5 things that are at the bottom of page 172 are what you want to highlight and keep in mind. So this has to be your principal residence. No home for the past 3 years. There's going to be purchase price limits. Rough, I haven't looked at it recently in South Dakota. They all kind of vary depending on where you're at. But I think they're in that 205 range, plus or minus. So you can buy a pretty decent house with this. There are income limits. And so again, I haven't looked at this recently, but I would say in Sioux Falls, a family of 2 is going to be somewhere around that $70,000 range, $60,000. And so that usually is the tough part for people to qualify, depending on where they're at in life. So they put restrictions on you that you can't refinance without paying back this benefit that you get, okay? Because you're also getting a below market interest rate with this. And so that's what they're talking about with the recapture tax. In addition to that, number 5 is you really can't sell this house within 5, what is it? Might be a little longer, 9 years, without paying that recapture tax also. Unless your income is below a certain level or you don't make a profit on the house, that type of thing. There's some exceptions out of it. You don't see them coming to ask for the collection of this very often. but it is in there. But it's a neat program. A lot of your houses, if you're going to be dealing with that kind of first-time home buyer crowd, and so a lot of times it depends on your age getting into the real estate market as far as the age of your clientele, but it could come into play regardless of where you're at. You'll just might use it more depending on that niche that you find. And so it's a neat program. And so they have this term called mortgage correspondence. And this is just kind of a general name for the two parties that we're going to discuss. And so a mortgage correspondent is a middleman between the actual lender and the borrower. Okay? So if you have a broker, so you have our three parties up there, and the borrower is going to this broker to get this loan. The broker has the ability to look at all these lenders that are out there. When I had my mortgage company, I think we had contracts with something like 80 different lenders. So it all depended. If you were buying an acreage that had over 12 acres, this lender was the best one for that. If you were buying a fourplex, this lender was the best one for that. And so they all had these kind of niche little products out there, depending on where a person was at. And so this broker can do all the shopping around for you and find you that best package to fit your need. Now, when you go to close, the broker doesn't put up any money. All that money goes from the lender straight to you. Okay? And that in particular is what makes this person a broker. Now, the other category that they talk about in here is mortgage bankers. And so it's basically the same setup, but now when you get your money, it's going to come straight from the banker. And the banker is going to create a pool of mortgages. Typically in that $1 million range. And then they turn around and sell that pool to the lender. Your Wells Fargo, your Bank of America, those bigger national lenders. Or they might sell it straight off to Fannie Mae, Freddie Mac, and that group. But the main difference is when you go to close, this money is coming straight from the banker that you had talked about. And so they'll close it with their money, they'll pool the mortgages, and then sell them off. And so from a practical real estate agent standpoint, brokers are nice when you have somebody who doesn't fit the conventional type financing, because they're able to find those niche programs to help that person qualify. But they can be kind of frustrating because the money that you need to close is being wired in from someplace out of state typically. And so a lot of times this takes a few extensions. It takes a little extra work on our part. Where banks are really nice because when the bank downtown says that we'll do this loan and closing is Friday, that the money's going to be there and you're going to be able to close. And so there's some nice efficiencies with that, but brokers obviously have their place in the market still.
Want to use a broker over a bank if party, we'll say, what's specific about making it?
It could be what is being financed. And so with some of the new regulations, banks kind of over-regulate themselves. And so they won't even consider a situation that is non-conventional. Okay. And so one that we run across a lot here is if there's too many acres for the house, Fannie Mae won't buy it. Okay, so banks won't do it because they have no place to sell it. And so a mortgage broker might be the best situation in that case. It used to be credit scores, and now brokers still probably have a little more flexibility with credit scores than what banks do. But if somebody had bad credit, only option you had was a broker because banks weren't going to touch you. Yeah, banks are ultra conservative. Brokers are completely profit driven. Not that banks aren't. Banks are just as greedy, but they're greedy in a conservative sense.
Yeah, they have more regulations on what they can actually let people.
Yep.
Do they normally take chances, or they're just
Well, a broker doesn't. It's that lender that they're finding apparently takes more chances. If that makes sense. Okay. Another term that's in there, I was trying to find this on my book for you, is a portfolio lender. And this is a lender that will keep the loan in-house. So we already talked about Home Federal. They're probably one of the last, in a general sense, that would fit into a portfolio lender where they originate the loan and they keep the loan in-house. They don't sell it to a secondary market. They service it. And so when you write your check, it's to Home Federal every month. And it's all right there with them. A lot of your banks will do this, but you have to be kind of, I don't want to say a privileged customer, but you have to be a good customer. You have to have at least 20% down. And this is just something that they might do for you as a service versus being an area that they actually want to work in. And the mortgage bankers that we talked about, they're going to be using their own money, and then they turn around and sell this either to a larger lender or onto the secondary market. So your mortgage brokers make money primarily on origination. And so your mortgage brokers traditionally are more expensive than mortgage bankers. But sometimes they can find, like I said, those better niche products that ultimately save your borrower money. Bankers make their money two ways. They make it up front in the origination costs, but they also make it on the back end with the premium if they can get the person to enter into above market rate loan. And so sometimes banks are going to be cheaper in a traditional sense for financing. And so the hard part for the folks that struggle with math is just not to freak out, okay? There are three variables. They're not going to give you more than that. And you just need to be able to plug them in with the corresponding letter, okay? Now, worst comes to worst, they guarantee, AMP guarantees no more than 10% of the test is math. And so you can punt on all the math questions, even though there are some easy ones. It just means you have to get an 85 on everything else to pass. Now, one more of these, and this is the typical thing that they like to make us do. So annual interest is $10,000. Now on the test, if you just get the term interest is X, you can assume that it's annual interest. They don't always do a great job of labeling that for you. So annual interest is $10,000. Rate is 12%. What is the principal? I think I used hard enough numbers this time you had to use a calculator. $83,000. Repeating threes. Anybody agree? So what they love to do on the test for some reason, which is kind of hard for some of you to grasp, is to divide by a percentage. And so we'd like to multiply by a percentage, but I find that people struggle when it comes around to that division part. But just trust the formula, okay? And so it's the simple ERP or ERV formula. So our interest, $10,000, the rate, and we're solving for principal. So does everybody agree with the 83,333? Okay. That's about as hard as it gets. And this applies to so many different things. Later on today we're going to talk about discount points. And so a discount point is the amount of money that a borrower pays up front to reduce the interest rate over the life of the loan. It's always a percentage of the loan amount. So if somebody's paying 2 points, it's 2% of the loan amount. And so it's just like having an interest rate of 2. Rate times principal gives you interest. So if you have 2 discount points times the loan amount, the interest will be how much those discount points cost. Okay? Any questions on that? Piece of cake. All right. Back to the book. Page 175, Truth in Lending. Truth in Lending is a big statute. Covers a lot of different things. From leasing a car to buying a house, to any type of commercial financing, whether it is an actual loan or lease situation. So one of the terms that's going to come up in Truth in Lending is Regulation Z. You also have, if you look at the bottom of page 174, you have the Home Ownership and Equity Protection Act, or HOPA. That is actually part of Truth in Lending. It was an add-on that went into place right after the whole subprime crash. The biggest part that you're going to see on the test with truth in lending is going to be Regulation Z. And Regulation Z requires a disclosure of a thing called the annual percentage rate, or APR. So let's say we're driving around town listening to the radio, and Ford, Chevy, Honda, Toyota, one of them comes on with an advertisement. And they say that there is 0% financing right now. As soon as they throw out that term of financing, an actual hard number, they have triggered Regulation Z in truth in lending. And so this is where they hire that speed talker at the end of the commercial to go through the whole disclosure. That's to be in compliance with the truth in lending. You see it on TV, that's all that little boilerplate that you can't even read on a digital TV that comes up once they start talking about all of this. And it's been triggered because their advertisement had started to discuss hard financing terms. And so one way to keep this in your mind is anytime an ad has a number, it needs to comply with with Regulation Z in the truth in lending. And so what do they have to disclose? The big thing they have to disclose, number one thing, is going to be the APR. This stands for annual percentage rate, but you can think of it as actual percentage rate also. Because if they tell us that financing is at 5%, but there's going to be a $50 application fee, they're going to require us to pay $50 for a credit report, and then there is going to be a $1,000 transaction fee. All of these have to be added into that 5%. And so now your APR is going to be, and I'm just making this up, 5.9%. And so what truth in lending requires, even though most of us don't understand percentages, what that actually means to cash coming out of our pocket, it requires anybody that is financing, or lenders in a financing transaction, to disclose the actual cost of that money. And so they can't just say it's 0% financing. That doesn't make any sense, right? Who in the world is just going to give us a car to pay, over the next 5 years? They have to make money on this someplace. And so APR will come in and say, no, it's actually 1 or 2%. They'll disclose where some of those fees are in there. Okay? Does that make sense? So on the test, if we're looking at a 1-year loan for $10,000 and it's 5% interest, and we have these associated fees, right? We can calculate what the APR is going to be. Okay? So the first step is to calculate our annual interest. So we have rate times principal equals interest. So if we take our principal times our rate of 0.05, that gives us how much? $500. Okay? Now we add all of these into it. 1,100, right? And that gives us a total interest of 1,600. Now we plug it back into here. Interest divided by our principal of 10,000 gives us a rate of 16%. So this would be our APR. Our fees, so 50, 50, and 1,000. And it's been known to happen, not very often, but if they ask you to calculate APR on that national test, it's got to be a one-year loan, and it'll just be a simple situation like this. Chances are they're just going to be talking about the facts type of thing, having you recall what comes up with truth in lending. So truth in lending is consumer protection. Regulation Z requires that disclosure of the APR, and that disclosure, when you're going in for a loan, has to include those 8 things that are on page 175. So the date the financing charges begin, the APR, the number of payments, the date payments are due, any payoff penalties, charges made in case of late payment or default, sufficient description of the property, and total finance charges. Now, typically, according to Truth in Lending, that this isn't triggered by your first mortgage on your house, but it is by your second mortgage or a home equity line of credit. But the way banks operate is that they always want to be in compliance, and so they comply with this in every transaction. And so if you financed your house, you've actually seen this Truth in Lending disclosure. It's got a row of boxes about a third of the way down that all of these numbers are set out in. Okay, so you know when the ads are triggered under Regulation Z, whenever financing terms are talked about, you have to disclose that APR. When you're going in for your loan, lenders are required to give a full APR or a full Regulation Z disclosure, which includes those 8 things. Okay, so now you're starting to see why this might be a little complicated on the test, because you're going to have questions specifically in those areas. Okay. Now you're also going to have questions on the stuff that's on top of page 176, and this deals with who is exempt from this Truth in Lending disclosure. So business loans. Remember, this is consumer financing. Business loans never fit into your unsavvy consumer. Commercial loans, the same thing. Loans to corporations and partnerships. Installments, which means payments of 4 or less. Loans where there's no finance charges. I don't know if that's necessarily a loan. And assumption of a loan by a new borrower. Okay, so what helps me remember the nature of this transaction? No need to make disclosures. Commercial loans, the same way. Okay, so where would you have to make that disclosure? And that's for that uneducated consumer to make sure that they're protected. Now, another thing that comes up with this is the whole 3-day cooling off period. It's called the 3-day right of rescission. Now, this is part where your first mortgage, you don't have a 3-day right of rescission. But on your home equity line or your second mortgage, you would have. And so if anybody has ever had a home equity line of credit, you know that they don't give you that money when you close the loan. You always have to wait 3 days, right? And so if you change your mind, you don't want the loan, all you have to do is sign a piece of paper, fax it back to the lender, and you're done. You have no fees, no obligations. But that only applies on your home equity lines and your second mortgages. Yeah, at closing, you would sign this 3-day right of rescission, and it gives that borrower 3 days to make up their mind whether they want to do this deal or not. Now, it's technically there when you buy a car. You finance a car, you have 3 days in order to decide whether you want that financing. But there's a little rub, right? You've also signed a contract with the dealer saying that you're going to buy this car. So if you turn down the loan, how are you going to make that up to the dealer? You have to have some other option, cash, that type of thing. And so when you're talking about your house, there's no strings attached. Okay, I want to finance my house in order to use this money to buy something else. I can walk away from that financing after 3 days. But if I've already bought something else with it, I have to make up that money somehow. Well, let's say that our house is worth $150,000 right now, and we owe on it $90,000. Okay, so we have loan value equity. We have $60,000 in equity. Okay, so a home equity line of credit gives you access to some of the $60,000. And so you can go in and get that loan for $20,000 and use that to buy a vehicle versus getting a regular car loan. And so when you go into close, you have 3 days to decide if this is a good thing or a bad thing. And no, good. What I was talking about with the, so let's use this situation. 100,000, 90,000 first mortgage. And we have our 60,000 equity, right? I guess I could use the same drawing. But now we are allowed by lenders to get up to 80% loan to value, let's say. So we're going to get another loan for $30,000 that is secured by our house. This $30,000 loan is called a second mortgage. Okay? So we basically have two mortgages on the same property. So that's that terminology that I was using. So you see at the bottom of the page, right before we get to RESPA, we get into some of the triggering terms. We've already talked about the trigger terms there for advertising. Anytime you're using numbers is the big thing. That's when that APR disclosure is going to be required. But at the bottom of that page gets into some of the penalties that are there. So I've never known a lender that goes to jail for a year because they violated truth in lending. But there is criminal punishment there as well as fines. There are some guidelines out there that are fairly harsh for lenders that fail to give this 3-day right of rescission. And that is that it could become an absolute right of rescission. So if they have failed to give this and the bank has to foreclose on the house because that loan's gone bad, and they go back through the paperwork and they see there's no disclosure, that borrower can actually claim that it wasn't given to them and rescind the loan at that point. And so it can have some harsh effects. So lenders don't miss this very often. Now the next big one, this probably plays more into what you do than any of the other regulations we're going to talk about today, and that is RESPA. And so RESPA stands for Real Estate Settlement Procedures Act. And it deals with anybody that provides settlement services. And so there's kind of an acronym in RESPA, SSP, Settlement Service Providers. Real estate agents are one of those. Appraisers are one of those. Lenders are one of those. Title companies fit into there. Home inspectors, anybody's service that is necessary in order to get a real estate transaction closed is a real estate settlement service provider. And the main thing RESPA is going to prohibit is kickbacks within this industry. And so it must have been something to practice in your Chicagos and New Yorks and places like that prior to RESPA being put into place. Because if you had the buyers, where are you going to send them for financing? You're going to send them to the ones that give you the best steaks, the best cigars, the best cars to drive. You know, there's a lot of soft money in there. And if you're the lender that's getting all these buyers from that real estate agent, what title company are you going to send them to? You know, you're going to send them to the ones that are giving you the best. What appraiser are you going to use? Appraisers weren't necessary prior to RESPA because it went into effect before PHIRA did. But that's kind of the nature of the thing. And who ultimately pays for all these kickbacks? The consumer. Those are all passed along. You know, it's just kind of a cost of doing business. So it all goes down to the consumer. And so this is what RESPA came in and said, no more kickbacks. And so if you're ever approached by a lender that says, I'll give you $50 for every buyer that you bring to my office, your RESPA alarm ought to be going off in your head. This isn't right. This is illegal. I'll give you free advertising. They're pretty sensitive about this. I read a case a few years ago where a title company was giving out Christmas baskets. And they got nailed for a RESPA violation because they weren't giving out Christmas baskets to every real estate agent, to every lender. They were only giving out Christmas baskets to the ones that were using their services. And so, you know, how many thank yous have each of us done like that? You know, I need to do something nice for this. Let's put something together and give it to them. That doesn't work amongst settlement service providers. You want to do that for your client? Perfect. That's great customer service. You want to do that for a friend? That's great. But you don't do it for an appraiser. You don't do it for a lender. You don't do it for a title company. There was another case where a broker was renting a room kind of like this to do a presentation for their agents from a title company, and it ended up being a RESPA violation. They were paying $1,200 a day for that room. And the going rate in their market was something around $300. And so that extra that was on top of it looked like a kickback to that title company. And that was a RESPA violation. And so they're very, very serious about this. The other thing RESPA does is that it's going to, and this is part of another antitrust law that comes into play. But another thing that's kind of related to this type of thing is in the Sherman antitrust law, I don't know if we look at today or not, but there are no commission sharing relationship, or not commission sharing, that comes out of RESPA, but commission setting relationships allowed in this industry either. And so if Dwight ends up in a different office from Tyler, they can't get together and say, hey, how much are you charging for commission? And so there's no fixing the market that way. Okay, so once you're licensed, you can talk about commission in office, but don't ever talk about commission with agents outside of your office, because it fits into that. I remember when I was practicing back in Gillette, Wyoming, I got a phone call, and they said, "Hey, did you know so-and-so's charging this an hour?" And I'm sure within about a week, everybody raised their rates to such and such an hour. And so, it was no big deal. But I've heard stories from real estate agents that have had FBI agents knock on their door because they've been overheard in airports and places like that talking about commissions with somebody else. And so they take it serious in real estate for some reason. Now, another thing that is kind of along that borderline of kickbacks in RESPA is sharing commissions with unlicensed person. There's a few of these reality shows on TV anymore, isn't there? And I think there's one, and there's so many of them now, but it had to do with rehabbing properties. Flip This House, I think probably was the original one, to where they would hire these people kind of generically referred to as bird dogs, and they would go out and find these opportunities, and they would pay them $500 for every one they closed on. Well, in South Dakota, that's going to be illegal. And in RESPA, that is also borderline illegal whenever we have these fee-sharing relationships. And so those types of things force the price of a real estate transaction up, which is passed on to the consumer. In South Dakota, that example that I gave is bad because you're sharing fees with an unlicensed person. Okay, if you're paying for a referral, let's say that Adam is working at a lender. He has somebody come in and say, I'm interested in buying a house. I'm just getting started. I wanted to talk to you first, make sure financing and all that's in order. And Adam says, yeah, we got you approved. Do you have a real estate agent you're working with? Oh, no, let me give Fred a call. I know he'll do a good job, treat you right, all that kind of stuff. And so, unbeknownst to that consumer, I've agreed to pay Adam X for every one of those referrals. No, that just doesn't work. That part, we can't share fees at all. And so a lot of people don't use that term kickback. That sounds bad, right? So let's just say referral fee. I'll take you out to lunch. That type of thing. All of that stuff is kind of marginal when it comes to RESPA. So what does RESPA apply to? It applies to first mortgages that are federally related. And so federally related means it applies to just about everything a bank does. And so anybody that's insured by FDIC, their transactions are federally related. You have your FHA loans, your VA loans, any HUD administrated loan, any loan that's going to be sold on the secondary market. All of those fit into that federally related transaction, and RESPA is going to come into play. Now, there's also a couple other things that come out of RESPA that the borrowers that are going to govern lenders more than they do us, and that is a statement at the time that the borrower makes the application that's referred to as the good faith estimate, okay, the GFE. So what's the good faith estimate does is spell out the cost of that loan. The origination is going to be X, the interest rate will be X, your title fees will be X, your appraisal fee will be X. It used to be a one-page form, but during this whole financial reform thing, they've changed this into roughly a 4-page form. And so it's much longer, and they have a lot of different rules. Some of these fees cannot vary any. Some of the fees can vary 10% one direction or the other. And some fees can vary completely. And so The ones that can't vary at all are basically the lender-based fees, the ones that they control. And so if they're asking somebody else, then those fees can vary a little bit. And so they can estimate on that day of application that appraisal is $350. But when they get the bill at closing, it could be $400 because that's a settlement service provider that they didn't have control over. And so that type of fee can vary. Now also, in order to close the loan, the lender has to prepare a thing called a HUD-1. And this is their basically settlement sheet for the transaction. This is how much the real estate costs, this is the loan, these are all your fees, and at the bottom it's going to say this is how much cash you have to bring to closing for the borrower. Now remember that good faith estimate said this is what the fees are, and some of those fees can't vary. And so if you get the HUD-1 and those fees are different, we have to start the whole process over again. And so you'll have a delay in closing. Or the lender will have to just go with the fees that are part of that good faith estimate.
You don't use both of them, you use either one.
You have to use both of them. But they have to, yeah, prior to this, you would see, and this was kind of a notorious broker thing, you would see a lot of bait and switches, where closing costs would be $3,000 on the good faith estimate, and when you got to closing, it would be $6,000. Okay? So now, under the new rules, if they say $3,000, when you get to closing, it's got to be $3,000, or you got to start the whole thing over again. Some of them can, yeah. Yeah. No, there are three types of fees that are really there. You have the bank fees. And this is zero tolerance. Okay? They can't vary at all. And then you would have, I don't even know what to call them, things like taxes that are kind of set fees that you can look back on. And those can vary 10%, I believe is what the parameter is. And then you have the settlement service providers that the bank has no control over. And these can vary. Okay, so you have the good faith estimate, right? So that's exactly what it is an estimate of what the closing cost is going to be. Then you have the HUD-1, and these are actual costs. And they can vary as long as they meet these parameters. And so bank fees cannot vary. Taxes, yeah, they can vary because they do occasionally. And then the settlement service providers. I mean, you hire me to come out and appraise your place, and I tell the lender it'll be $400, and I get out there and there's actually two places. I'm going to double my fee and charge $800. And so I can do that because I didn't know exactly what the assignment was until I showed up there. But if where you run into trouble is where you have the zero tolerance and the 10% tolerance, and they vary more than that on the HUD-1 compared to the good faith, that's when you have to start everything over again. RESPA, well, we got 2-3 days we're confusing here, okay? So RESPA deals with the first mortgage, okay? And that 3-day comes into play whenever you have to reissue the good faith estimate. There becomes that 3-day window that you cannot close within that 3-day window. But Truth in Lending on your second mortgages also has a 3-day period, and that's the 3-day right of rescission, that the borrower has 3 days to get out of the loan after it closes for your second loans or your home equity loans. And it gives it, and it's consumer protection again, right? Because now you have 3 days to get out of there if you feel like something's going wrong. But there were horrible stories on the whole bait and switch thing prior to the recession, prior to this new standard, where, I mean, people were literally forced to come up with this money, or threat of litigation and all this kind of stuff. And usually, because these are refinance transactions, there's equity involved, and so you have these predatory lenders. They'll say, well, you don't have the extra 3, 4, 5,000. Let's just take it out of that equity, and that little bit of extra money you thought you were getting in the transaction has to then go to the lender, and they're just kind of pushed into that. And so we didn't see a whole lot of that around here. There were some of it, but nothing like you heard in other places of the country. All right, so the next piece of legislation we have to look at is the Equal Credit Opportunity Act. And it is part of the Civil Rights Act. Okay, so this is kind of that whole fair housing mindset brought into the finance world. And so it is supposed to help take out all of those decision-making things that should never be part of a decision-making, and just look at the facts of the situation to see whether this loan ought to be made or not. Now, one thing that's going to be tough, you know, you would think that it would be easy enough to just say no discrimination. But we just can't do that. And so one of the tough things for a real estate test is that we have different protected classes in all these different laws. And so what are protected classes in fair housing? Race, national origin, familial status, disability, religion. Should I write these up on the board? Okay. Race, national origin, there we go, color, religion, what chapter is our fair housing in? Not yet. This one's fair housing. I should write that on top. So has anybody looked that up yet? We have them all? Yeah. You have them all? So we're already starting to fall prey to what these test makers like to do, okay? Because they're going to give you this list of protected classes for fair housing, and you have to know them dead. There's no way around it. And then they're going to add in here ECOA. And they're going to give us some protected classes. And what do we have here? Color. Religion. Do we have sex in ECOA? Gender? Okay, so it's a completely similar but different list, right? Nope. Nor is disability. But marital status isn't part of fair housing. Age isn't part of fair housing. And receipt of public assistance isn't part of fair housing. Oh, they will screw you up with this. If you don't
Have to try too hard.
if you don't know it dead, I don't know
Okay.
any way to get past these questions, because they'll have answers that aren't the complete list. They'll have answers that's more than the complete list, and unless you know them, there's no way to get through it. And they do all blur in your head. I don't know how many times I've talked about them, and I always want to verify that we have the correct list up there. So Jeff, you're a loan officer at a bank, and you have an 85-year-old person that comes in and wants to do a 30-year mortgage. Are you going to give them that loan? They receive Social Security. Yeah. And so you have an 85-year-old, their only livelihood is Social Security. If everything else qualifies, you give them a 30-year mortgage. And so we think of this as a real estate thing. You know, how somebody can buy a $200,000 house if they're on welfare. But Equal Credit Opportunity Act applies to all credit. And so you're looking at somebody that wants to finance a $1,000 car. Okay, that fits in there. They might be able to do that. You have people that are seasonal workers. You know, they work 9 months out of the year, say doing highway work or something. Then the other 3 months, they're on public assistance. They're on unemployment. And so they would still qualify. Social Security, you know, is a big one. You have disability, that type of thing. And so they fit into there. It doesn't work very well, like I said, with real estate transactions, because those numbers are so big that usually that money isn't sufficient enough to cover. The one that you might come across is that person that's collecting unemployment for a few months every year based on that job. And so they would fit in there. Okay? And so this protects spouses. And so you should be able to go in and get a loan in your name and not have questions about your spouse and your spouse's income. And that information shouldn't be disclosed the other way around. All that stuff's protected under ECOA. That didn't always used to be that way. And so the one place that there's a little bit of an exception in ECOA is with age. We'll talk here in a little bit about a thing called the reverse mortgage. And so if you have paid a lot down on your house over the years and now you're 62 and you want to get basically annuity type income coming in, you want to get a check every month over a set period of time, you can use that equity in your house to do that. And that's referred to as a reverse mortgage. But there's age restrictions on that. Not everybody can get a reverse mortgage. You have to be at least 62. And so since that's a qualifying factor for that loan, you can ask somebody, how old are you? Just to make sure that they meet that criteria. Now, we're saying here that we can't discriminate based on any of this stuff, right? So let's jump ahead a little bit to HMDA, page 180, Home Mortgage Disclosure Act. And what this says is the federal government wants you to tell us about the people that are getting loans. We want to know their race, color, religion, national origin, all this stuff that's protected. And so you can't ask this, or you're not supposed to use this, but when you're filling out the loan application, when the borrower's in front of you, you have to go through and fill that in. You have to ask for it. Yeah, you can't. They're writing it down, putting it on the loan application. The one exception for that is if you're taking the application over the phone, then you just have to make educated guesses, basically, is what it says. Well, what they do, there is another branch of the Federal Reserve that compiles all this number, and part of their job is to look where the housing needs are around the country. And so they're looking for things like income, credit scores, that type of stuff, to where they can actually create a profile. And what they find is a lot of the economic divides in our country are also socio divides in our country. And so they usually go together in those housing needs. And so they use it to accomplish two things. One, track patterns of discrimination, and two, to allocate federal funds to different housing areas. Okay, where do they need housing money? Probably not Sioux Falls, South Dakota, as much as maybe a rundown neighborhood in Chicago, or Pine Ridge, or places like that. Let's look at a neighborhood in Philadelphia. Okay, so let's say a neighborhood in Philadelphia is 95% African American. Okay, you go through and look at all the loans that originated in this neighborhood, and only 50% of the loans are originated to African Americans. Guess what? There's discrimination going on there. If 95% of the population is made up of this group, and only 50% of the group is getting loans, of the loans that originated, there's a problem there. And it probably comes back to the discriminatory practices of the lenders that are in that area. And so it, and quite honestly, I think color and race and all that kind of stuff really isn't, when they're looking for housing needs and things, really isn't part of what they're looking at. They're looking at the money, the wherewithal for areas, the purchasing power, that type of stuff. And so they look at it more, allocate it based on that economic need. Unfortunately, that economic need hits different groups harder in this country still. And so, but they will use the other parts, the race, color, national origin, to track those patterns of discrimination. Because we know from census, what is the makeup of Sioux Falls? So everything that's done in Sioux Falls should follow that makeup, whether it's loans being originated or, cars being bought, all that type of stuff should have the same kind of mix. And if that mix is off considerably one way or the other, the reason it is probably because of discrimination. And so that's kind of what HMDA is there for. So that's Equal Credit Opportunity Act. Questions, try and think of questions on the test that you can't ask about. So you can't ask somebody how much alimony they're getting, how much child support they're getting, that type of thing. If they volunteer it to use it as income to qualify for the house, then if they say I receive $800 a month in child support, the lender needs to verify that there's a pattern of this child support actually being paid, and so it becomes part of the deal. But if they just come in and they say this is how much I make, the originator can't ask, well, don't you also get child support because of that divorce last year? That is off limits. You can't get into that. So another thing that comes from Equal Credit Opportunity Act is from the time of application for that loan, the lender is on the clock. And so within 3 days of application, they have to either say, here's your commitment letter, we can do the loan. You have failed to get me all the necessary documents you need, so your application's incomplete, or you've been denied. And here are the reasons. Does that make sense? What else comes within 3 days of that application that we've already talked about in RESPA? GFE is the acronym? Good faith estimate. Yep. So good faith estimate also comes within 3 days of application. Now, a lot of times what lenders do, they already have this package put together, especially in real estate transactions. It takes like that fast for a computer to tell you whether you're qualified or not. Goes out, pulls your credit score, you've already put in all your income, and it comes back and either says, we have a loan commitment or we don't. And so you rarely get that incomplete application thing. And so all of it, before you walk out, you have that commitment letter, you have the good faith estimate, all of that. Now remember, the commitment letter is based on supporting all the information you gave. So you still have to bring in W-2s and tax returns and all that kind of stuff. But you would know based on that information whether you qualify or not. So Fair Credit Reporting Act. Has anybody signed up for LifeLock or any of those types of services? Have you actually locked your credit where you get notices if somebody accesses it or not? And so it's a pretty neat service. There's variants out there. Most of your credit card companies have some type of service like this. And LifeLock is just kind of the popular one with Super Bowl commercials and that kind of stuff. But you can have them actually lock down your credit. And so you receive a notice if anybody tries to steal your identity, basically, and use your credit to acquire anything. And so it gives you notice, email, however you want to receive it, that this has happened. And it helps protect that credit score. And so, has anybody ever had an issue with somebody stealing their credit? Name? Yeah, sometimes some of that stuff happens pretty easily. Say that you went to Lowe's, both of you went to Lowe's and you financed a refrigerator or something. And nobody had used those accounts for a few years, so Lowe's goes in and merges them, thinking they might be duplicate, and all of a sudden you two are tied together. And so things like that can happen inadvertently. You also could have somebody that just blatantly has gone out and figured out your social security number and that kind of stuff and starts using it. And so this all kind of fits into that whole reporting thing. And so the Fair Credit Reporting Act, with all of its amendments, gives us the ability to see our credit scores every year. It gives us ability to get a service like LifeLock in order to come in and help prevent identity theft. But it also places a lot of onus on lenders and people who use our credit, that people can't slander our credit. They have to have justifiable, proven debt to report on it. And it gives us the ability to see our credit report if we're ever denied a loan based on our credit. So if I go to ABC Bank and they say, sorry, Fred, you don't have good enough credit to buy a house, they give me a notice that I've been denied based on credit, which gives me the ability to go to the credit union or an online service and get a copy of my credit report that way. We should be able to get how many free credit reports a year? I think it's up to 3, but you get 2 for sure, and then I think you get the 3rd if there's any adverse credit action, you can access it. It used to, I mean, back 10 years ago, if you would shop around for a loan, you would go to ABC Bank for see how much they would charge, and they'd pull your credit, and then you'd go over to XYZ and they would do the same thing. Because you had your credit accessed twice in a short period of time, it would have a detrimental effect on your credit score. And so they have since done away with that rule. And so if you're in the same search for credit, multiple multiple hits on your credit won't take it down. But if you get hit in a 10-day period by a credit card, a furniture store, a car store, and a bank for a home loan, all of a sudden you have all these, looks like you're on a spending spree or something, and those start to have a negative effect on that credit score. Each one will lower it. National flood insurance. It's one of those things you absolutely, positively have to have if your house is located in a flood zone. The problem is the only place to get flood insurance is from the federal government. And so if Congress is unable to reach a budget deal, guess what? There's no money for flood insurance. And so it's a necessary thing, but it's kind of a pain in the butt when it comes to real estate, especially in the last few years. Yeah, because you get budget gridlock in Washington, and one of the things that suffers is allocation of federal monies to this flood insurance program. And so you can have real estate transactions on hold for months when that happens. Now, every piece of property has to have a flood certification. So there's a $15 fee, maybe more now, but $15 fee last time I looked at it, for every property. Even if your house was built on top of Mount Everest, you would have to have somebody certify that it was out of the floodplain. And so if you're within the 500-year flood line is when insurance starts to come into play. Sioux Falls, hopefully this summer they'll finish the whole levee system. And once they do that, a lot of Sioux Falls will be up out of the floodplain. I think the whole city will be. And so that'll help quite a bit. But in 2009, they came in and redid the Army Corps of Engineers came in and redid the flood maps around town. And they put a whole area over in kind of the north central to northwest part of town into the flood zone. And so all these people who didn't have to have flood insurance all of a sudden had to have flood insurance because of that. And it's expensive. It could be thousands of dollars a year depending on the value of your property. So it's just one of those necessary things. Once the new flood maps are approved, then it goes off. Yep. Yep. It's kind of that same year is when they took a whole bunch of houses up in Aberdeen off of it, and that's when that flood came in. And people who had had flood insurance for years finally didn't pay for it because they didn't need it, and that's the year the flood happened up there. Community Reinvestment Act. Big thing to remember out of this is redlining. And so, fair housing kind of prohibits this activity. Community Reinvestment Act encourages the opposite effect. And so remember, redlining is when lenders come in and say, we're not going to lend in this neighborhood. Property values are decreasing. Foreclosures are increasing. It's just not a good investment for us. The problem with just having a blanket approach like that is that it has a disparate impact across our society, and it affects certain groups harder than others. And so they have to look at each transaction on a case-by-case basis. And what the Community Reinvestment Act, the CRA, does is actually encourages lenders to put money into these neighborhoods. it affects their rating. And so every bank is rated on this. So a couple of years ago, I was in Philadelphia teaching a mortgage class, and they had in an actual newspaper article there this discussion on the CRA. And there were a couple of banks, and this was right when the recession was starting to happen. They had a couple of banks that were in the running to buy a failed bank in the city of Philadelphia. And they made the decision on which of the banks was able to buy that failed bank based on their CRA rating. And so the one that did the best at reinvesting in neighborhoods that needed that reinvestment were the ones that were able to come in and buy that bank. And so that's where banks really see the benefit, is they get kind of privileged treatment if they're doing a good job with that CRA investment. Now, the only places in South Dakota that qualify for CRA investment are the reservations. And it's virtually impossible for any banks to lend money into reservations because the reservations don't have a mortgage system. So there's no way for banks to secure the loan that they make to any type of collateral. And so it's basically like, here's the money, I hope you pay it back, because there's no other way for us to get the money back. And so because of that, there's very, very little investment into the reservations in South Dakota. The next section is going to be Americans with Disabilities Act. So a definition for a disability is an impairment of a major life function. So Lucas, what's a major life function? Walking, talking, seeing, hearing, thinking, sleeping, drinking, eating, waking up in the morning in a relatively happy mood. And so the whole list of disability is absolutely enormous, really based on this definition. Because just about everything we do in a day probably fits into that major life function. And so Americans with Disabilities Act is the definition that is used for disability and fair housing. Okay, this came about just about the same time as that fair housing amendment. What you'll need to know for the test are the 4 titles. So Title 1, Employment. Title 2, Public Services. So your state, local governments, government buildings. Title 3 is your public accommodations. So you notice the date in there, by 1992, this is the top of page 80, by 1992, your public establishments needed to comply with it. That means buildings built from that point forward should be ADA compliant. There was a little problem in that most of your cities used the UBC as the building code, and the UBC wasn't ADA compliant, and so you had a lot of buildings that were up to code under that, but not ADA compliant. And so most have switched over to the International Building Code, which has alleviated that problem. And then Title 5 is public communications. So this is your relay services, phone service for the deaf. Now, ADA really is kind of a non-issue for real estate agents. I mean, we can't discriminate because of fair housing based on disabilities, but we really aren't in a position any other way. I mean, we don't want to make representation that something is ADA compliant when it isn't. You'll probably have one of those simulation exams dealing with that. But it's just one of those things that it's more up to the seller to make sure that they're selling something that's ADA compliant if that's the case. That make sense, Ken? Well, Title III doesn't fit, houses don't fit into that. That would be a building like this. And so this building was built in the 80s. There's no need for it to be ADA compliant. And so it wasn't like it's not like a government building that had to be retrofitted to become compliant. If this was built today, it would have to be ADA compliant. Okay? But all of that is within reason. You know, you have two ground level entries, the front of the building and the back of the building. Okay, so that it's easy enough while you're making it to make that ADA compliant. Everybody can basically roll in or walk in off the street. It works fine. You have to change, you know, make sure hallways are wide enough, that type of stuff. All that's easy to do when you're building it. The only time you would have to do that on a building would be if you do substantial remodeling, then you have to bring it up into code. And so, and they, like I said, they do it within reason. You know, we had two ground level entries here, but let's say we had a two-story building. You know, this level has to be ADA compliant. But if there's no elevator accessing this level, that level doesn't have to be ADA compliant. But if we put an elevator in here where a disabled person could get access, then it would be ADA compliant. And, you know, the funny thing, when we're talking about ADA compliant, we're mainly talking about somebody in a wheelchair when you're looking at buildings. You know, you're not talking about any of the other disabilities, really. You know, you would, the one other one that comes into play is making sure that you have the Braille codes on the wall in the appropriate places. So we talked a little bit about HMDA there. HOPA is the next thing. We also briefly mentioned it as being part of Truth in Lending. And this deals with higher priced mortgage loans. So everybody's familiar with that term subprime, I hope by now. We've heard it a lot over the years. But one of the things associated with subprime was high interest rates. What went along with a subprime loan is that because this person had bad credit, we would give them a loan at 10% interest for 2 years. And then we would force them to refinance. And we charged them $5,000 in order to do this loan. And then 2 years later, we're going to charge them $5,000 more to redo this loan. Interest has gone up a little bit, though, for another 2-year period. And so these people are in the situation they're at because they're not very financially savvy. They're having a hard time either because lack of income or lack of responsibility meeting their obligations. And so we take a lot of their money in order to give them the privilege of owning that house, both in interest rate and in origination. Then 2 years later, they haven't got ahead any, and maybe even have gotten behind, and we're going to take some more of that money just to keep them in that same situation. And so that's what HOPA comes in to control. It doesn't say lenders can't do that, but it says if they do that, there are certain things that you have to do. One, you might not be able to refinance in 2 years. You might only be able to do that every 5 years. And you have to give them disclosures that we're really ripping you off type of disclosures. This is excessive fees, and we have to tell you how much is excessive. And if it's too much, we might not even be able to charge it. All right, let's jump into FHA real quick. Top of page 81. When did FHA go into place? 1934. Remember what's going on in the country in 34? Depression. You know, we had banks failing all over the place again. Yeah. And so it came in to act, like we had talked about, as that first kind of secondary market. And it worked a little bit differently because it created this new concept of insured loans. So what this means is, let's say that we made a loan for $100,000, and we have to foreclose on this loan. And when we sell it at foreclosure sale, we only get $80,000. So that means that we have a $20,000 loss, right? And so what the FHA insurance comes in and does is pays the lender the $20,000. And so it insures their loss. The lender still has to go through the whole foreclosure process and is responsible for all of that. But it's going to make sure that the lender is whole when this is all said and done. Now we'll kind of revisit this a little bit once we get to VA loans, because VA loans are guaranteed, and so that works out a little bit different than what insured loans do. Now, one of the ways that FHA stays viable is that it charges the borrowers fees. And the fees come in two different shapes. We have a thing called an upfront mortgage insurance premium. And then you have your MIP, mortgage insurance premium. Okay, so before we make sense of the gibberish in that example at the middle of page 182, let's look over real quick just to the top of page, I messed up this morning, I see, but to the top of page 183. I think I wrote 97.5 on the board instead of 96.5. And so you have the FHA 203B loan. This is the most popular FHA loan out there. Okay? And it requires a 3.5% down payment, right? Okay. So now we understand that. Let's jump back to page 182 and look at this example. This is an example of both the upfront mortgage insurance premium and the mortgage insurance premium. Okay, so we have that loan of $150,000, right? And so we have to have a down payment of 3.5%. And that down payment is what size? Okay, so if we subtract that from our 150, we get a loan amount of $144,750. Okay, everybody with me to that point? So the next thing that they're going to do is calculate the upfront mortgage insurance premium. And so it's 1.75% of the principal balance. Okay? So we'll multiply this by the 1.75%. It's in that paragraph at the top of the page. Now, rest assured, they'll tell you how much the upfront mortgage insurance premium is if they make you calculate it. Okay, they're not going to have you memorize that 1.75. All right, so how much is this premium? $2,533.13. Okay, so this has to be paid at closing. You can actually, under FHA, if you don't have the cash to pay that at closing, you can add it to your loan and finance it over the 30 years. I would say 95% of the time that's what ends up happening. And so most of the time it's just added on. Okay? Now the next part of this is to calculate the mortgage insurance premium. And so they do this on an annual basis with FHA loans. So at this first year, we're starting off with a loan amount of how much? Yeah, $144,750. Okay, so now we take this times, what's our premium? 0.55? And that gives us how much? $796.13. We divide that by 12 months, and that gives $66.34. And so that's going to be added to our mortgage payment every month. And so FHA loans aren't the cheapest loans that are out there. They're great for people who don't have much for a down payment. You only need 3.5% down versus 20% down. But it's going to be more expensive. I mean, $2,500 right off the top, plus you're paying interest on that $2,500 for the next 30 years. And then you have your $66 and change every single month. Yeah. Yep. It used to. It doesn't anymore. And so it used to, when you had 20% equity, that they would take away the mortgage insurance, that they would take away this part of it. And they felt that that was a disincentive. And so they're trying to incentivize people not to use FHA loans. And so this stays on for the life of the loan now. You just refinance and get out of it. And, you know, this is all refundable if you refinance over the first, I believe it's 6 years of the loan. And so it's prorated. So if you would refinance after 3 years, you would get half of that back. And so that part of it's nice. Now this stuff, this And this was like set in stone for 20 years. And we hit the recession and they start changing these numbers around, raising them, because FHA is struggling also with the foreclosures that they have. And so all of that are moving numbers, so I don't think you're going to see those on the test. And so you just need to recognize the mortgage insurance premium and the upfront mortgage insurance premium to understand what those are. Okay? All right, one thing to keep in mind on the bottom of page 182 really has nothing at all to do with FHA loans, but this is where they decided to throw this in. I think we talk about it again later in the next chapter, is a discount point. Okay, so whether you get a test question talking about origination, a lot of times they'll call it origination fee, or they're talking about discount point. When we're taking the test, we could really care less what they're saying if it is a math question, because they are all a percent of the loan. Okay, you just have to read the question. Is it 1? Is it 2? Is it 3? Is it 3.5? Regardless of what they're throwing out there, it's going to be a percent of the loan amount. Okay? I almost guarantee this is where we're going to have a problem on these tests. Because this is simple, right? 1% of the loan. But it's the loan, not the purchase price. Okay? Natural tendency is we get going too fast and we don't read the question. We don't take time to organize ourselves before we answer it. So make sure you're calculating this on the loan. It's not on the purchase price.
I was just talking about that. I think I need to make a list on my little notes when I get in there about, I'm not going to get the document down now, but it was about that, like looking for words like and, or semi-annual, that.
Yep.
And so that when I read my question, am I looking for these types of things? Make sure I'm looking for things.
Yeah. These people that make up this test, if you look at their business card, after their name, their title is psychometricianist. And so they've gone to school to measure the mind. And so they know how the mind works, all that kind of stuff, and they're going to prey on that. Have you ever seen, I've seen it come across in emails and that kind of stuff, to where they have this paper written out and they've omitted like every third word and you could still read it? That's where our brains work, and that's what happens on tests. And we'll skip some vital stuff in there. That's why multiple choice questions are virtually impossible to get 100% on if they're written by an expert. And that's because they're using these things. Instead of saying for, they'll use the letter for. Or, they'll write out annual, or they'll throw in a per year. All those types of things, just varying it that much is just enough for our eyes just to skip over it, not to register in our brain, and we come to the wrong conclusion.
Then my brain starts calculating what happens, so then as I read through it, I'm already calculating, and I'm thinking.
Yeah, I guarantee that most of you will probably have over half an hour extra when you're done with the test. Some of you might be just slightly under that, but I would say that you'll have at least that amount of time. And so you have plenty of time to slow down. It's on a computer screen, so you might feel kind of stupid. But they give you scratch paper. It's okay to hold it up there and just read the question line by line. Slow yourself down. Another thing that happens, I've had it happen to me before. I start taking this test, and I have no clue what the first question's asking. I don't remember it. It doesn't make any sense. I can't figure out there's no answer that goes with that question. I go on to number 2, and it's the same way. Sometimes I have to get down to like 10, 12 before I've actually started to breathe and relax and my brain starts working. And so there's nothing at all wrong with just skipping through, reading a few questions, trying to relax. Oh, there's a gimme. I know that one. Answer a few of those. You can't exit the test until you've had the opportunity to answer every question. So it'll keep taking you back to get those that you haven't answered yet.
But I heard with the math one that if you take it, don't come back and do it.
Well, I would say that's true for any that you've answered. Don't go back and redo.
If I had heard the big
Yeah. The only ones that I'd say to do that is if you know for an absolute positive that you're just guessing on it, write it down on a scratch paper so you could go back to it. Because usually you're going to get 2 or 3 questions on the same issue. And so sometimes if it's asked from a different angle, it goes, oh, that's what they were talking about in that question. And it could kind of trigger that. But I would say for the most part, don't ever go back and change anything. If you skip them, that's fine. You could go back and rework them. But if you've already worked them, just let them go. Okay? So here's another cheat. You're taking this test, and you're getting a question on what type of FHA loan is this, and you just cannot remember. Always guess 203B. That's going to answer most of the FHA questions on the test. It's by far the most common loan that FHA does. It's the one that's part of first-time home buyers. A typical person, if they just have 10 or 15% down, they're going to be put into an FHA loan, and it'll be the 203B. Okay, 203Bs will finance 1 to 4 unit properties. So single-family house to a 4-plex. This is the one with the 3.5% down payment. It's over on top of page 183. So it's probably good to highlight some of that stuff, the numbered stuff there. You can get help with this down payment or with closing costs and such. A seller can pay up to 6% of the loan amount towards closing costs for the buyer. The buyer just has to have that 3.5% down payment on equity. So one thing to keep in mind is that seller's 6% can never go towards equity. It can only go towards closing costs. Okay? So if closing costs are only 4% of the loan, that's all that the seller can pay for. Yeah, it can't go to equity. Yep. Any fees. Yep. Now that one exception to that really is that first-time home buyers. Because the buyer needs that 3.5% down, they can use that loan for that 3.5%. Okay? And actually you see that come out in, they can get if they have a Harley, they can hawk a Harley and use that money from that to pay the 3.5% down too. Okay? And so it can be from any collateral that you have. It doesn't have to be cash. But banks get kind of funny if it isn't cash that's been in your bank account for 3 months. And so they make you start proving everything. So you see number 1 there is the down payment may be a gift from a blood relative or nonprofit. And so there is a program under, I think it's Sioux Falls Housing that handles it. Might be South Dakota Housing. I think it's Sioux Falls Housing that has a grant, like a $3,000 grant that they'll give people to get into houses. That would be a nonprofit agency providing that money. Number 2 is the money may be borrowed against collateral, that Harley we were talking about. And then 3, the seller may pay all the closing costs and prepaid expenses. They just cannot contribute towards that equity down payment. They have a discussion there on bottom of page 183 about FHA interest rates. I don't know how old an issue has to get before they quit talking about it sometimes. But FHA interest rates, just about my entire life have been market-based interest rates. When it first started off, they were set by the federal government. I think at the time that in 1982, before this was overturned, it was capped at 8%. That was the maximum interest rate a lender could charge, while the market rate at that time was in the upper teens. And so banks weren't even using FHA loans because it didn't make any sense. They were losing money if they did an FHA loan. And so the federal government finally realized that, and they just did away with that capped interest rate. And so now it's market rate. Whatever the market is what the FHA rate is. Over on page 184, they're talking about a loan assumption. FHA loans used to be what referred to as freely assumable, which means if I had the loan, it didn't matter at all what Jeff's credit score was or whether Jeff had a job or not. They would just let Jeff take over my loan. And so the bank had no say in it. And that really doesn't make any sense. And so now a person has to be approved. They have to qualify. And if you're going to go through that, it might be just as favorable for you to get your own loan rather than to assume a loan. Because your down payment requirement's going to be a lot less. Now, you might also come across some other FHA loans. They're listed over the next couple of pages. So you have the FHA 234. This is the same as the 203B, except it's for condominiums. Okay? So if you're going to finance a condo, you would use the 234. Does anybody know what the Fannie Mae requirement is for owner occupancy in a condo unit right now? Fannie Mae will only come in and buy a condo loan if the condominium development is more than 50% owner occupied. And so there's a lot of condos around the country where there are only tenants in them or there's nobody in them, very few people that are there. And so condos are kind of a tough market right now. I know there's some condos on the west part of town where they didn't take off very well, so they have one person bought 1 out of 4 units in a building, and the other 3 are tenant owned, and so those people are basically stuck because nobody could come in and buy it and finance it because it's less than that 50% rule. And so there are a few examples of it around here, but FHA 245 is what's referred to as a graduated payment loan. And the way these work is the graduated payment is based on interest rate. And so they start off at lower interest, and over time they work up to a higher interest rate. And so this FHA loan probably isn't too favorable right now with most of your lenders, but it's still one that's on the books. And so it would allow somebody to probably initially get into a house at say that you could get in at 1.5% interest for your first couple of years, then it bumps up 2.5%, then 3.5%, then maybe up to 4.5% for the rest of the loan. And so it's just to allow somebody that has their income prospects look good. They're like a doctor just out of med school, that their income's going to go nowhere but up, would be somebody that would fit into something like this. Now, a really neat FHA program that they have is the 203K. And so any of these are fair game. If you have 5 or 6 questions on FHA loan programs, I bet you 3 or 4 of them are 203B, and then the rest of them are going to be these other miscellaneous programs. But the 203K program is a program you could use to rehab a property. If you look at HUD foreclosures around the area, they'll tell you in those ads whether or not this qualifies for a 203K loan or not. And so a 203K loan lets you borrow the purchase price of the property, but it also lets you borrow the construction costs up to a certain limit and up to 6 months worth of mortgage payments. And so it basically gives you 6 months to get the property flipped and turned around, either resold or fixed up to where you can get potentially different financing in place for it. And so the whole intent behind this is to give a mechanism to fix up some of these rundown properties. A couple of other things that come out of there: there's no upfront mortgage insurance premium. It applies like any FHA loan that we've talked about here, 1 to 4 family units. FHA does have some multifamily products, but they're outside the scope of the class. And they lower the down payment, which can be a gift in the case of a 203K. Kind of foreshadow a little bit of what we'll talk about later is dealing with an ARM loan. So there's a lot of different components to an ARM loan. There's an index, a margin, those are the two that they throw into there. There's also a couple of other things that are important. And that's the adjustment limits. In an ARM. And so ARMs tend to get a bad rap. They're really good products, but they're not for everybody. And so ARM loans make a whole lot of sense on short-term financing type things. There's some risk involved if you're looking at them over longer-term times. But FHA loans are ARM loans are very conservative. And so you will notice in that discussion that they have a max on the 1 year loan, 1 year adjustment. They have a max of 1%, and they have a max over the life of the loan of 5%. Okay. So the index is whatever measuring index that this is tied to. And so there's a lot of different ones out there. You can see prime, LIBOR, coffee, Cody. Does all that sound like gibberish? So the prime rate is kind of tied to that discount rate that the Federal Reserve sets. Okay? So prime rate right now can't go any lower than what it is. It's about 1%, 1.25%, somewhere around there. Okay? Your LIBOR stands for is basically, I mean, you saw a scandal this last year over price fixing on the LIBOR, but it comes from a European bank model. What is their overnight lending rate? So kind of their discount rate. Coffee is a cost of funds index, and then CODI is cost of deposit index. And so all of these indexes really, from a U.S. standpoint, are pretty closely tied to that Federal Reserve discount rate. That's going to have a lot of effect on it. And so these things, the index is what is variable. So you'll get this test question. Which one is variable, the index or the margin? And it's always the index. The margin is set. And it's kind of the negotiable part. Is it, typically it's 2 to 3%. So you'll have LIBOR plus 2. And so if you look at that FHA ARM down at the bottom of page 185, this is kind of the worst case scenario where your interest rates continue to increase every year. And so the first year you're at 5%, and it hits the max in year 2, so it bumps up to 6%. Same thing in year 3. And so at year 6, because your interest rate can only increase 5% over the life of the loan, you hit that lifetime max of 10%. But if you think about that in today's model, okay, you start off with an interest rate that's around 2%. The highest it's ever going to get is going to be 7% during the life of that loan. And that's manageable. That's not too bad. I mean, 7% seems high right now, but it wasn't all that long ago that 7% was a great rate for financing. And so what really controls whether it's the safety or risk of an ARM loan is these adjustment limits. How much can they adjust in a year? How much can they adjust over the life of the loan? Some have no limits, and so you're really kind of, if you're going to do it over a long term, you're playing on the skinny branches. Yeah. So it'd be typically a 5 to 10 year FHA ARMs, or 5 to 10 year. Don't worry about Title I. We don't need to cram that into our heads. So we'll jump down to VA loans. Now, in order to get a VA loan, you have to be a qualifying vet. In order to establish that you're a qualifying vet, you need to have a certificate of eligibility. They talk about over on page 187. You also have to be honorably discharged. That forms a DD 214. So once you have established that eligibility, you see the guarantee set out over at the bottom of page 186. So the guarantee loans up to 50% if you're buying a house $45,000 or less. A lot of those around. Maybe in some of our smaller towns, but not too many around our larger towns. So really where it comes into play then is in number 3, right? Anything in excess of $203,000 will be at 25%, up to a maximum of $50,750. Does anybody know what that's 25% of? So type in your calculator 50,750, divide by 25%. That'll give you your answer. 203? Okay. The loan price. Yeah. Okay, so what happens here in just kind of a general rule of thumb, and this is where that kind of traditional 20% down payment comes from, is if you have a $100,000 house and you take it to a liquidation sale, so next week we're going to sell it on the courthouse steps, absolute auction, it's going to go to the highest bidder no matter what. Historically, this is going to bring $80,000 at that sale. Okay, so that's why banks feel fairly safe. If they get 20% down payment, they should be able to get that 80% if they have to take your house and sell it on the courthouse steps. And so they're going to feel pretty secure with that. And so with your VA guarantee, the VA is guaranteeing 25%. And so they'll pay up to that 25% range. That guarantee usually takes the place of the vet's down payment. So most of the time, VA loans are 100% financed because the VA is guaranteeing that equity that the bank usually relies on to be made whole if it should go to foreclosure. Okay? So if you get over that $203,000, you might see banks requiring vets to have down payments to help cover the difference in that guarantee. Now, this is a renewable benefit for vets. Okay, so that guarantee is 25%. So let's say that they paid their mortgage down to, what did we say, 25% or how much? 50, 250, 750? Okay, so let's say that they have a $100,000 mortgage. So their 25% is $25,000, right? And so that means that they have $25,750 of that benefit back because that's the maximum guarantee. And so they can actually use that on the purchase of another property. I've never seen it, but that's my understanding of how it can be used. Now, they also talk about VA loans being assumed, right? So you have another vet come in and assume this loan. They're assuming this $25,000, so that first vet then has a full eligibility to use when they go and buy the next house. But if it is just a member of the public comes in and does this instead of a vet, that vet's guarantee sticks with the house if they're assuming that loan. And so they don't get their whole benefit back until this is either refinanced or paid off. And so if a vet's mortgage is assumed by another eligible vet, that eligibility is 100% restored to that first vet. If the assumed mortgage, or if the mortgage is assumed by a member of the public, then the vet's guarantee stays with that property. Now they talk about funding fee over on page 187. I've never seen that or even heard of that coming up on the test as far as knowing the actual numbers. But this is kind of like that upfront mortgage insurance premium. There is no mortgage insurance on VA loans, but they do have this upfront premium that they have to pay. And that is just to kind of fund the administration of this benefit that they have. Now, another thing that is important to keep straight as we're talking about all of this stuff, and that is FHA does not ever lend any money, right? They're never personally lending any money. It's always a bank that is using an FHA program. So it's the bank's money that goes out. The VA typically does not lend any money. It is always the bank's money that's being lent out under a VA project. And so again, if you're not reading the questions carefully or thinking it through, it's easy to get conned into one of those answers where FHA's making a loan or HUD's making a loan. And that's not their job. Their job is just to administer and oversee those programs. Now, one where they might actually lend the money is going to be for your rural development loans. Your Farmer Mac, as they were formerly known. So the one thing you need to know is the definition of rural. That's 20,000 people or less. And so that fits into a lot of South Dakota. You will see that. I've seen a number of rural development loans in Harrisburg, even though you draw a radius around Harrisburg and you're bringing in a big part of the population. And so if you can get that area where there's 20,000 people or less, this is a viable option. The qualification requirements are going to be the same as an FHA 203B. Now, the one difference is that these loans can either come directly from rural development or they can come from a private lender. And so this is where you'll get that distinction on the test. As far as who's making loans and who's not making loans. So the only one out of the three we've just talked about, FHA, VA, and rural development, that can actually lend money, it would be rural development. Nope. If I had $100 to bet today and was willing to do it, I would say you probably won't see a rural development question on the test. Okay, so PMI, what does that look like that we've already talked about? What's the other acronym that's similar to this we talked about just a couple topics ago with FHO? Yeah, mortgage insurance premium. That's what you call it if it is an FHA loan. If it is just a conventional loan, we'll call it PMI, private mortgage insurance. Okay, so they operate kind of the same way, even though FHA's MIP doesn't go away now. It used to follow the same rules as PMI. And so if you had this is all loan to value over here, these percentages. You had a loan that was up here. About 90%. The lenders would require, and they still do, require you to have private mortgage insurance. And so what that mortgage insurance covers is basically this exposure that the bank has when the property goes to foreclosure. And so when they go and foreclose on it, remember they typically get 80 cents on the dollar. And so this private insurance kicks in and covers that amount of the loan that was over the top of it. Now, if you go back and read through all this government research over this recession and financial debacle we've gone through, one of the things that they said hurt the banks the most out of all the mistakes that they made was to allow people around PMI. Because you used to be able to get a loan for 70% and another loan for 20%. And so you would have two loans, but because your first mortgage was only 70% loan to value, you didn't have a requirement for PMI. And so when all of these properties started to go into foreclosure, you know, just getting that margin over the top of what they got on the properties would have helped a lot of the banks survive. But because they kind of cheated the system and got around it, it hurt. Now, remember when we looked at that example, that cost an FHA, that cost $66 extra a month? You're going to have fees for this on top of your mortgage payment. And so they can be substantial. I've seen PMI fees upwards to $300 a month. And so it all depends on the value of that mortgage that you're getting, value of the house that you're financing. Now, technically, once you get it paid down, let's say in there, I think it 78%, right? Technically, when you hit 78%, the banks are supposed to automatically drop this. Now, the one thing that isn't taken into account for the bank's calculation is appreciation. So if your property is getting more and more valuable, they're not taking any of that into account. They're just looking at that very first amortization schedule, what you bought it for and where it's at. So you're probably looking, you know, years down the road versus calculating a little bit of appreciation into it. You know, fortunately, our market started to turn around here where we're seeing 1.5%, 2% appreciation per year. The bottom of that page is the term conventional loan. So the best way to think of a conventional loan, probably for test purposes, is not FHA, not VA, not rural development. In a traditional sense, a conventional loan would require a 20% down payment. But basically, because it's not a government-backed loan, it fits into that definition of conventional. Is that simple enough? Private loans over on top of page 89 basically don't exist anymore. And so the whole subprime, when it got its start, the subprime used to be private companies, not lenders, private individuals or private companies that would choose to invest their money in these higher risk mortgages. But now, because of new laws that have gone into effect, if you make more than one loan a year, in most jurisdictions, you have to register yourself as a lender, and you fit in underneath the parameters of this new legislation. And so you don't see private loans very much. You might see a contract for deed here or there, but you don't see somebody actively as a private individual in the loan area. So loan sharks, you're going to have to find something other than real estate to work on. So have you guys talked about equitable interest versus legal interest? Don't remember? Those aren't completely Greek terms, are they? So you talked about the bundle of rights. Okay, so you own something in fee simple absolute. You have all the rights in your bundle of rights. Okay? And so an equitable interest occurs when one of those sticks is handed to somebody else. Okay? So when buyer and seller sign a purchase agreement, the buyer gets an equitable interest in that property. It's kind of that future interest that's realized fully when they close and they get ownership. But up until that, they could say, I have that place under contract, right? I have an interest in that place. And that is referred to as an equitable interest. Legal interest is the easiest of these two interests to determine. All you have to do is look at a deed. Whose name is on the deed? And that is the person who has the legal interest in that property. But you can get an equitable interest if Dad decides to leave this property to you in his will. That's an equitable interest. If you have the right to cross this pasture to go fishing, you have an equitable interest in that pasture. And so they're harder to prove because you usually don't have a written document that goes along with it. So when we have been talking about these mortgages, we have the borrower, who goes to the bank to get the loan, right? And so the borrower gives the bank a mortgage. And the bank gives the borrower money. Now, if you would go to the courthouse, whose name is on that deed? The borrower's, right? So the borrower has the legal interest, and the bank has an equitable interest because of that mortgage. It gives them the right to be able to take that property if there's a default. So everybody's following my logic here? So this is your typical mortgage case. Now over on page 189, they're talking about a thing called a land contract. Okay? So in a land contract, you have the borrower still. And now you have the owner, let's not call him owner, let's call him seller of the property. And in this case, we kind of reverse things around a little bit. The seller is giving the contract to the borrower. And we call it around these parts contract for deed. It could be a land contract, land installment contract. It could be called a lot of different names. But around here we call it contract for deed. And the borrower is giving the seller money. They're making those payments over time. Okay? So now, in this situation, if we'd go down to the courthouse, whose name is on the deed? The seller's name. And so now we have the seller that has the legal title. And the borrower is the one that has the equitable interest. Okay, so a land contract is just a form of seller financing. And the main thing that's different are these interests. You know, in a traditional transaction, the borrower has legal title. In a land contract, the seller's going to have legal title. Now, the only time this really has any effect is if the stuff hits the fan. What's the bank have to do in order to get the property back? Foreclose, right? They have to go through that whole process. What's this person have to do? Kick you off. And it's theirs because their name's already on the deed, right? That's called strict foreclosure. So we left off with right at the start of the loan process section. Top of page 190. And this isn't very test question heavy stuff. This is more kind of a practical way through it. And so it's one of those things that it's a good idea to have a little bit of idea of this process because you're only a couple weeks away from actually hopefully taking somebody and getting them started in this process. And so the first part starts with the application. That application, remember, from those previous regs that we read, is kind of the triggering event for things. We have the trigger in RESPA for the good faith estimate. We have a trigger in the Equal Credit Opportunity Act, because you have 3 days to say whether they've been approved, whether they've been denied, or if they have an incomplete application. And so the application is made on a standard Fannie Mae form. So Fannie Mae's kind of standardized all of this stuff. And so it's called a 1004. They make their application on that. And it is this application that is used to qualify the buyer. Okay? You see on the next couple pages later, we'll flip back and forth a little bit. Middle of page 192, they talk about automated underwriting. And typically, when you get the application filled out on the computer, you have the permission to pull the person's credit report. You hit a button, the credit report just automatically pulls into the application. One more button, and it's sent off to automated underwriting. And in about 10 seconds, you get an answer back from the lender of whether or not a person's qualified. And it tells you, you know, there's different levels of qualification. The highest rating is going to get you the cheapest loan. The lower rating will increase your down payment, might increase your costs to get the loan, that type of thing. And so it does have an effect on the cost of it. But it's all pretty much instantaneous, especially if somebody's organized and they already have a couple years of tax returns, they have their last couple of W-2s. It pretty much is done at that point. And so once a person's approved, that's when the lender is going to coordinate some of this. They're probably going to select the title company if the borrower doesn't have an opinion and if the seller doesn't have an opinion. They're going to also select the appraiser. And now it doesn't matter if the borrower has an opinion or the real estate agent or the loan officer, because they can't have any part of the appraisal process. There has to be somebody independent from the loan to make this decision. Some companies, some lenders have kept this in-house, ordering the appraisal, but most companies have farmed this out to a thing called an appraisal management company. But that appraisal will be done. You guys look at your purchase agreement already, and there's a clause in the new standard form that says, do you want the property appraised before or after the home inspection? That's the way that it's phrased. I'm thinking straight, aren't I? Sound familiar? Okay, so this is all part, more than actually needing to know some of this stuff on the test, this is a bigger part of how do we coordinate this in real life. So we have all of these things that have to start to come together in this process. And so one thing that's very important is for a real estate agent to be good at preparing that purchase agreement, because that purchase agreement is the roadmap for everybody to get from agreement to closing. Okay? The lenders need to look at it. If there's anything specific in there, somebody paying points, somebody having a preference for a title company, anything like that, it has to be spelled out to give that lender direction at that point. And this is also one of those things. And so it probably requires effort from the buyer's agent to point out to the lender that, and this all depends on how hands-on you want to be, but let's don't order this appraisal, don't obligate my client to any cost until after we find out this house is going to pass inspection. Okay, so all this kind of comes together with other things in this whole process. And so once you have that appraisal, and the lender is pretty much just going to go and verify the information provided for on the application. and that is all done, it's going to be ready to close. That takes a little while. It seems simple, but it typically is going to take at least 30 days in order to get this done. Some markets are going to be different. I know out in Rapid City, it takes six weeks to 2 months to get the appraisal back in a lot of situations. You know, Aberdeen's even worse than that. I heard that they're out 3 or 4 months. And so that makes it kind of tough with the interest rate locks and all that kind of stuff. A couple of things that it's also good to know is the list at the bottom of page 190, things that they're going to be looking at in order to qualify that buyer. You realize that job stability is important to lenders? You know, they're going to call and verify employment. Not everybody knows that. So they usually call right about that time of application, then they usually call the day or the day before closing. And it's been known that people have quit their jobs in between there. And then they're upset at somebody besides themselves because they can't get a loan. And so there's a lot of things that you kind of have to juggle occasionally with buyers to make sure that they stay there. Some of the money sources, you have bonuses. It can't be a one-time bonus. It's got to be an annual bonus. You have to have a history of it in order for it to be used. Second jobs, again, you're going to have a history of having the second job. Just because you've worked there 2 weeks, you're not going to get credit for that income. Same thing with child support, overtime. How long does it take to qualify for a loan after you file bankruptcy? It drops off your credit after 7. You should be able to qualify after 2. Now they're also, as much as they're interested in your income, they're also interested in your debt. And so they want to see how much your payments are. Not necessarily the amount of the debt, as much as your monthly obligations to pay on that debt. And so there's certain limits in there. And so they call this the total debt ratio. Total debt to income ratio is the way that it fits. So your debt payments versus your income coming in. Okay. Your typical FHA margins and VA margins are 41%. So you have to have disposable income then of roughly 59%. And if you're looking at conventional loans, that goes up a little bit to 43%. And there's a couple different ratios in there. They want to look at a ratio for just your mortgage payment versus your income, and then your total debt versus your income, your monthly installments. So credit scoring's down at the bottom of that page. It's referred to as a FICO score because the company that created it is called Fair Isaac and Company. It's a very complicated algorithm that they use to manipulate the variables that are part of this credit score. You can make $1 million if you could figure out a way, surefire way to manipulate that. But it's pretty difficult. So they look for, what have you done with your last debt? How have you handled it? Have you been timely? Have you been responsible? What's your current level of indebtedness? One of the main things that fits on there is the amount of time the credit has been in use. So you hear people that say that they cut up their credit cards and it ruined their credit. That's because they probably cut up a credit card that they've had for 15, 20 years, and all of a sudden their length of credit has dropped tremendously, or is, turned to nothing. And so that is a big factor. It's number 3 on the list. And so if you have no length of credit, that's also going to have a negative impact on your credit score. It's probably a good thing overall, and so it's kind of hard to sometimes measure up the responsible thing to do with the way that it affects you. Pursuit of new credit we've talked about, and then the types of credit that are out there. So your credit score ranges from 350 to 900. I have seen a few 350s. I've never seen a 900. So I guess it's much easier to achieve the bottom than it is to achieve the top when it comes to credit scores. So you see some of the Fannie Mae discussion there as far as people that might have a credit score below 620. Actually, I think they've increased that now to 650. And so it would be a credit score between that 620 and 650. In order to get that loan, you would have to show that you have a strong equity position. There's the debt ratios I was talking about. 33 is the amount of your mortgage versus your income. The 38 is the amount of your total monthly installment debt versus your income, which would also include that mortgage payment. And then you'll also see sometimes lenders will require that a borrower has 3 or 6 months worth of P&I payments in the bank before they'll do the loan. Now, there are also private companies that investors that are out there that buy these pools of money that operate on the secondary level. But the primary ones you'll see on the test and the ones we'll talk about today are the government sponsored entities or the GSEs. Now, it used to be that Fannie Mae and Freddie Mac were kind of quasi-governmental is what they called them. They were chartered by the government, but they were privately owned type of thing. And that is all done away with now. And so that used to be a common question on the test. I don't think you'll see that anymore because the government took over both Fannie and Freddie as part of the whole financial system bailout. And so Fannie Mae was the first one created. So that's a good thing to keep in mind. So she was the first one created in 1938. And was given $10 million. I probably wouldn't, she couldn't get through the month with $10 million. If she could get through a week with it these days. And so her initial basic function, her initial function was to help out the FHA loans. And so the government would insure them, then they would come in and buy the loans. But that has been expanded on, so it's no longer just FHA loans. But Fannie Mae has certain parameters that if a person meets this, that they'll buy the loan. Since most banks are going to sell to Fannie or Freddie, these parameters that they have created basically have become the standard in the lending industry. And so they purely serve as a warehouse now, as that true secondary market, where they buy it and add liquidity to the primary market. Ginnie Mae is the smaller of the two. One, probably the biggest thing to keep out of there, if you look at the second to last sentence in that paragraph, where Ginnie Mae is involved in a tandem plan, which allows Fannie Mae to buy high-risk, low-yielding mortgages at full market price. And so whenever you get a question on the test about which two of these secondary market participants come together, work together type of thing, just remember that the girls stick together. Okay? It's Fannie Mae and Ginnie Mae. Now the next one, the newest of the bunch, is Freddie Mac. Apparently we didn't have enough money going into that primary market, so they had to create another way to get the money into there. And the biggest out of all of them is also Freddie Mac. And it started off with the charter to buy conventional loans versus the government insured ones. Now it doesn't matter, at least as far as Fannie's concerned, whether it's conventional or it's FHA. They're both involved. So remember where these entities get their money, and that is by selling mortgage-backed securities. They have auctions to investors who provide them the money that then they can go and use to buy those pools of mortgages. One of the things that happened during the whole recession is that people quit buying mortgage-backed securities. So they would hold an auction and they wouldn't be able to sell enough of them in order to buy any of the loans on the primary market. And it really just kind of seized up the credit in the whole system. And so that's where you had the federal government coming in and propping up some of these entities just to make sure that there was cash going throughout the system as much as possible. They're kind of like bonds because they don't get you any ownership in the entity, but they get you a guaranteed return. Okay. Fannie, Freddie, whoever, yeah. Yeah, because you'll buy the paper at the mortgages, just like your credit score, are going to be low risk to high risk, and they'll have a rating system in there, and the mortgage-backed securities will be for those different pools. Let's say that we're talking about Fannie Mae. Okay, so our local bank here sells the mortgage to Fannie Mae. Fannie Mae turns around and sells a thing that's referred to as a mortgage-backed security to investors. And so say that this is for $1 million. This $1 million allowed them to buy a bundle of mortgages for $1 million down here. And this says, they're getting, say that they're getting 3.5% on that $1 million. That's what the mortgage payments are. And so for this $1 million, there's going to be a time limit in there. So maybe it's, 5 to 10 years, and they're going to pay them 4%. And so that is at that day in time, in order for them to get $1 million, Fannie Mae had to agree to pay 4% over that time. Maybe it's a good auction for them and they only have to pay 2%. Well, they don't borrow or anything. They're just a conduit for this money. And so they tried to raise it by selling mortgage-backed securities. And if they can't sell the mortgage-backed securities, then they're stuck with the government having to feed them money in order to keep it going. I mean, they're making money because they bought this and they have all these mortgages that are performing. And if everything performs right, they should have enough money to pay it out. It's just when they don't perform right. Because remember, we looked at, was $100,000 mortgage. By the time it's paid off, it's, 200 and some thousand. And so there's a little profit in there for the Fannie Mae, but they have to wait 30 years to realize it all. And so they're not, I can't say that they're not in there for the profit, but because they're a government-sponsored entity, profit necessarily isn't their bottom line. It is for the investors. But the main function for them is to keep the liquidity in the market, not to get rich.